Welcome back to the Deep Dive. Today we are jumping straight into Applied Digital Corporation, that's APLD, specifically their fiscal Q2 2026 earnings call for the quarter ending November 30, 2025.
And this is a fascinating one. It really sits at the crossroads of, the AI infrastructure boom and just pure aggressive industrial execution.
Absolutely. Okay, let's unpack this. Our mission is to figure out if they're really capitalizing on this massive AI demand, or if maybe their ambition is getting a little ahead of their ability to actually build this stuff.
Well, the market definitely voted. There was a huge after-hours pop on the stock. It suggests investors felt a real sense of relief, like management successfully de-risked the whole story.
And that optimism seems to be all about scale. Let's just run through the headline numbers really quick. Revenue was $126.6 million.
Which just crushed the consensus estimate of, around $90 million?
Yeah, $89.8 million. That's a 41% beat. Just massive year-over-year growth.
And the profitability, at least on an adjusted basis, looked just as good. Adjusted EBITDA came in at $20.2 million.
And the big one, adjusted net income, basically broke even, 0 cents per share. That blew past expectations of a 10-cent loss.
Right.
But hang on, let's talk about the GAAP number. The official accounting loss was $31.2 million, or negative 11 cents a share. That was a slight miss.
It was.
So are we sure the market isn't just getting mesmerized by a one-time revenue bump and ignoring an underlying operational loss?
That is the perfect question. And the difference between GAAP and non-GAAP is everything here. That huge revenue beat, it was almost entirely driven by upfront capital stuff.
Okay, break that down.
About $73 million of it came from what they call tenant fit-out services. This is for the big core weave contract. Another $12 million was recognized when the first part of that lease actually started.
So APLD is basically acting as the general contractor, building out the specialized facility for the customer, and they get to book that revenue up front.
Exactly. The core, the predictable recurring lease revenue, that was only about $8 million this quarter. But in a high-growth infrastructure story like this one, the market really focuses on those adjusted metrics. They signal the future value of the assets they're building, not the temporary accounting losses from depreciation and construction costs.
Got it. The market is voting on the future cash flow, not the current depreciation schedule. So let's pivot to the operational message, because management was crystal clear.
Oh, extremely. They basically said, demand is not the problem. It's infinite. The only constraint is execution and speed to power.
What's fascinating here is how they framed it. They called this an extraordinary land grab opportunity.
And they're not wrong. I mean, you look at the hyperscalers, your Googles, Amazons, Microsofts, they're spending over $400 billion a year on AI infrastructure right now.
$400 billion.
APLD is just trying to position itself as the industrial partner that can deliver the physical buildings and power faster than anyone else.
And they back that up with some frankly staggering numbers out of North Dakota. They have 2 massive contracts locked in, totaling 600 megawatts.
And that 600 megawatts over the life of these, say, 15-year leases, that adds up to about $16 billion in future revenue.
$16 billion. Just let that sink in. That's so much larger than their entire market cap right now.
It gives investors this huge, visible pipeline of future cash flow. But, and this is the big but, it all depends on them actually finishing the buildings on time and on budget.
Right. And they gave us the first big proof point this quarter. Polaris Forge 1, that's the 400 megawatt CoreWeave campus, got its first 100 megawatts energized, right on schedule.
That was huge for their credibility. It's the tangible proof the market was waiting for.
And the second big project, Polaris Forge 2, is a 200 megawatt lease with another big hyperscaler.
A $3 billion project. They expect the first power to come online in 2026 and the full build-out to be done in 2027. So you see this nice, steady delivery schedule taking shape.
And they didn't stop there. They actually raised their long-term goals. They now expect to surpass $1 billion in net operating income, or NOI, within 5 years.
Which is incredibly aggressive. For anyone who doesn't know, NOI is basically the pure profitability of the physical real estate. It strips out all the financing costs and depreciation.
So $1 billion in NOI would put them on par with some major established data center REITs that exist today.
Exactly. It's a huge ambition. And to get there, they need massive scale.
Which brings us to the new target, 5 gigawatts of total capacity by 2030 to 2032.
It's just a staggering figure.
Can we just pause on that? 5 gigawatts. What is that? Is that like a city?
You're not far off. It's enough to power several million homes. It's roughly the peak power demand of a major city like Chicago. They're trying to become a utility-scale provider of compute.
And to get there, they're already in talks for 3 more sites, another 900 megawatts of capacity.
And the key here is speed. They can move so fast because they're already qualified by 5 of the 6 big hyperscalers.
So all the difficult engineering and security checks are already done.
Pretty much. It means they can skip a lot of the due diligence and go straight to signing contracts once they have a location. It just removes so much friction from the process.
Okay, but a plan this big needs some serious strategic moves to de-risk it. Management spent a lot of time on how they plan to solve that speed-to-power problem.
Right. Let's start with the corporate structure. They're doing this ChronoScale spin-out.
This is the plan to combine their cloud platform with another company, Exo, and create a whole new entity.
Yes. The goal is clarity. It's to avoid what's called a conglomerate discount, where the market undervalues a company that's doing 2 very different things at once.
So they're separating the high-growth cloud business from the capital-heavy construction business.
Exactly. Let each one raise capital in a way that makes sense for its own model. The cloud business is already doing over $60 million in revenue, by the way. It's not small.
And APLD keeps a huge stake, right? Over 80%.
Over 80%. So they still get the upside from the cloud platform, but it's not competing for the same capital as the data centers. It's a smart move.
Okay, now for the really big bottleneck. Getting the actual power. This is where their partnership with Babcock Wilcox comes in.
And this is so critical. Management said on the call, if they ordered a traditional natural gas turbine today, they probably wouldn't get it until 2031 or 2032.
That's the entire industry's problem right now.
It is. So their solution is to work with B&W on a, let's call it a proven but overlooked approach using steam turbines.
They're not inventing new tech. They're just using a different supply chain that isn't bottlenecked.
That's the genius of it. It's basically a procurement and permitting hack. They think this can pull their power delivery forward by 3 to 4 years. If they prove that works, it's a monumental advantage.
So that's speed to power. What about the other half of the problem? The chips themselves are getting insanely hot.
And for that, they're investing in a company called Correntis, which makes advanced liquid cooling solutions.
What's so advanced about it?
Well, the next generation of chips, like NVIDIA's B200 or the new Rubin platform, are just incredibly power dense. Correntis designs these micro-channeled cold plates that are mapped to the exact hotspots on each individual chip.
So it's super efficient.
Wildly efficient.
Yeah.
It lets them cool chips that are 3 times hotter using the same amount of liquid. It basically future-proofs their buildings so they don't have to do a massive redesign every time a new, hotter chip comes out.
This all sounds incredible, but it requires just staggering amounts of capital.
This is where the story gets tense, right? The financing.
This is where the bulls and bears really diverge. Management laid out a very clear 3-step financing framework. The whole idea is to use third-party capital, not their own equity.
Okay, so what's step 1?
Step 1 is a $100 million development loan.
Right.
That's the short-term money for buying land and doing initial construction before they even have a lease signed.
And that gets them to step 2, which is the big one. Right. That's the $5 billion preferred equity facility. They can only tap into that after they've secured a big investment-grade lease. They've already drawn $900 million from it for the North Dakota projects.
Okay, and the final step?
Step 3 is project-level debt. They just did a $2.35 billion offering of senior secured notes. The goal is to build the project with that money, and then once it's up, running, and generating cash, they'll refinance those notes at a much lower interest rate.
And on the balance sheet, they ended the quarter with, what, $2.3 billion in cash?
Yep, $2.3 billion in cash against $2.6 billion in debt. And most of that debt isn't due until 2030, so they feel like they have a lot of breathing room.
Here's where it gets really interesting, though. Because despite that clear framework, the skeptics are all focused on one thing: execution risk.
It's the whole story. Can you actually build 2 giant campuses at once and then start on 3 more, all while dealing with supply chains, labor, and everything else? That is the multi-billion-dollar question.
Right. It all comes down to pouring concrete and energizing substations faster than anyone else. The market pop after the call was basically a vote of confidence that, yes, they can actually pull this off.
So the big picture here is that the market is buying into the $16 billion scale story. It was validated by the revenue beat and de-risked by things like the ChronoScale spin-out and the clever B&W power solution.
So what does this all mean for the near future? The catalysts seem to be clustered around a few key things.
I'd say 3 things. 1, just the timing. When do the next megawatts come online and start generating cash? 2, The ChronoScale deal actually closing in the first half of 2026.
And 3, the big one.
The big one. Proof that the B&W Power solution actually works and pulls the timeline forward. That announcement, expected in Q1 2026, is the next major hurdle.
All right, before we wrap, let's jump into our segment where we explore some aggressive ideas grounded in what we just talked about. This is not financial advice segment. This is where we pitch an outrageous but plausible trade idea.
And we have to say, this is purely theoretical analysis. We're just analysts talking. This is not, actual investment advice.
My pitch is a trade based on execution speed arbitrage, specifically that Babcock and Wilcox power solution. I think the market is underestimating what it's worth to cut 3 to 4 years off your delivery time.
It creates this huge temporary moat, an advantage over every competitor stuck waiting for traditional turbines until 2031. You can quantify that gap.
You absolutely can. So the idea is simple, if a bit leveraged. Go long APLD and pair it with a short position against a high multiple competitor whose growth story depends entirely on those traditional multi-year lead times.
It's a pure volatility play. You're betting on their engineering success.
Exactly. And the catalyst you're targeting is the announcement of a confirmed build schedule and location for that B&W Power site. Management hinted that's coming in early Q1 2026.
Once that's announced, the thesis is proven, and the market has to reprice APLD's speed advantage.
That's a moment. You close out the trade then.
I like it. It's a pure bet on engineering, and that's really the heart of this entire earnings call.
And that wraps our deep dive on Applied Digital. We hit the massive revenue beat, the $16 billion scale narrative, the de-risking from ChronoScale, and the key tech innovations with B&W for power and Correntis for cooling.
The final takeaway is pretty clear. The company has moved past being a story about demand. It's now a story about industrial execution, plain and simple. Success will be determined by whether their capital structure can actually support this 5-gigawatt build-out without hitting a wall.
So we'll leave you with a thought. In today's AI environment, with the world's biggest companies throwing $400 billion a year at this problem, which is harder to solve, finding the customer demand or finding the physical power to actually satisfy it.
Thanks for diving in with us. We'll talk to you next time.